Welcome back to the New Financial World Powering Tomorrow podcast, where we break down how electricity, technology, and digital systems shape the real economy. I'm your host, Zach here, and I appreciate everybody joining me again today for a wonderful episode that we have in store for you today. In today's episode, we're diving into tokenizing power, how electricity itself is becoming part of a new financial layer. We'll break down why combined cycle gas turbines still anchor grid reliability, how renewables generate monetizable attributes, not just electrons, and also how new credit-based economy is forming around energy production, flexibility, and verification. If you listened to our earlier episode on crypto foundations, we explained what tokenization actually is, turning real-world assets or cash flows into digital administered financial claims that can settle on modern infrastructure.
That I recently heard an interview with the SEC chair, Paul Atkins, and he was talking about the benefits of tokenization. And I always like to kind of explain what these terms mean for people. How would you describe tokenization and the benefits of it to average American?
Sure. So tokenization is simply creating a digital representation of something. It can be a bundle of rights. It can be an asset. It can be permission to do something. So we've seen all different kinds of assets get tokenized. Protocol tokens are one example, but people are tokenizing stocks and bonds. People are tokenizing real estate and titles to automobiles. People are tokenizing tickets to concerts and sporting events. The list goes on and on. I haven't even touched, things like meme coins, which are sort of tokenization of a joke, right? Yep. That's really what a meme coin is. And so because you can digitally represent anything on a blockchain, it really opens up the ability to have representations of assets and understand who owns the asset, know that you've established ownership and transfer of the assets. And so for us, tokenization is all about creating representations. It's the same thing we used to do with paper, right? There used to be paper stock certificates back when this floor was a mess of paper.
Yeah.
And those stock certificates were part of that. But now we've moved to computers, and tokenization on blockchains is sort of the next iteration of representing assets on computers.
And I feel like it democratizes finance as well. It will give
100%.
people, say, a commercial office building, somebody could buy through tokenization a piece of that.
Today, we'll be applying that framework to the most foundational system of them all, electricity. This isn't about hype tokens or speculation. This is about how power is measured, verified, monetized, and increasingly digitized. But first, quick disclaimer. This show is for educational, informational, and entertainment purposes only. Nothing you hear should be considered financial, investment, legal, or tax advice. Always do your own research and consult a licensed professional before making decisions. All viewpoints are of my own and are not of any employer or organization. Now, let's get to it. Before we talk about tokenizing energy infrastructure, we need to start with reality. This isn't theoretical. Today, tokenized real-world asset market already represents tens of billions of dollars in on-chain value. We're already seeing this in tokenized treasury bills, on-chain money markets, private credit instruments, asset-backed lending structures, select corporate bonds, early-stage renewables, and carbon credit tokenization. They're not just speculative coins. They are structured financial claims administered on blockchain-based settlement infrastructure. In other words, the first assets to move on-chain haven't been volatile bets. They've been stable, yield-generating instruments. The leading networks currently supporting institutional real-world asset activity include Ethereum, Polygon, Stellar, Avalanche, Solana, and emerging platforms like Sui. But here's the distinction that matters. The legal wrapper defines what the asset is. The blockchain defines how it settles. Tokenization succeeds when it operates inside existing regulatory and capital market frameworks, not outside of them.
Right. And if the crypto platforms are looking more and more like banks in terms of holding money, holding stablecoin, shouldn't they follow the same regulatory framework that the banks follow? I feel like this discussion has moved into trying to protect bank margins.
Yeah, I believe that blockchain operating systems will be very positive for consumers and disruptive to the existing rails for a lot of different processes: security, trading and settlement, consumer payments, international remittances, cash management for corporations globally. And that's a good thing. We want technology and innovation to advance. That's why Treasury Secretary Bessent, President Trump have said we want America to be the crypto capital of the world because of the importance of that blockchain operating system concept of lowering cost, increasing accuracy, reducing fraud, and providing consumer benefit. But I've said from the very beginning of this process, the issuers and users need to be all under the same rules, and whether they're bank-owned or not bank-owned. And so I think that's an important concept we've got to stick with.
Yeah, that is really important, what you just said. So
we're not talking about putting turbines on chain. We're talking about putting the predictable cash flows and attributes those turbines produce onto modern settlement rails, the same rails already handling tokenized treasury and private credit. And the same infrastructure is already being explored inside the energy sector. Major companies and utilities are beginning to test blockchain rails for tracking generation data, environmental attributes, and energy-linked financial claims. In Spain, Repsol has explored tokenization as part of its digital transformation strategy, using blockchain systems to digitize renewable project attributes and environmental data tied to power generation. In the United States, an industry consortium called Blockchain for Energy, backed by companies like ExxonMobil and Chevron, has been working with the Hedera network to build B4 Carbon, a system designed to anchor real-time emission data into a verifiable ledger and support tokenized environmental claims. And at the community scale, projects like Brooklyn Microgrid have demonstrated peer-to-peer energy trading where rooftop solar generation can produce tokenized energy credits that neighbors trade locally. And platforms like PowerLedger and projects such as SolarWise show how solar production and revenue streams can be represented as digital financial claims tied to renewable assets. Different scales, different approaches. But the underlying idea is the same. Real megawatts are already generating digital credits and tokenized claims tied to energy production, emissions, and grid performance. Electricity just used to be simple. You generated it, you transmitted it, you consumed it. For a century, power was treated as a uniform commodity, priced mostly by the kilowatt hour. That model is breaking. Today, every unit of electricity carries metadata. When it was produced, how it was produced, how clean it was, how reliable was it, where it was delivered, and who can verify those claims. That metadata now carries economic value. Power is no longer sold as just energy. It is bundled with attributes that can be priced separately from the electrons themselves. Those attributes are becoming credit certificates, compliance instruments, structured revenue streams. Electricity is turning into a financial signal. The grid is evolving from a delivery network into a balance sheet of measurable attributes, where every decision to generate, store, or consume can create both power and financial value. This is why electricity is no longer just a physical output. It's producing information. Every megawatt generated today consumes a digital shadow, like sensors, telemetry, performance metrics, grid frequency data, emissions measurements, operational efficiency data. Modern power plants don't just generate electricity, they generate continuous streams of machine data. And that data has economic value. Because in a digital economy, information reduces uncertainty. And reducing uncertainty is what finance pays for. Utilities and grid operators now rely on real-time data to optimize dispatch, predictive maintenance, risk, verify compliance, price reliability. A turbine spinning isn't just producing power, it's producing a live data set about the system. Predictive maintenance reduces downtime. Performance data supports financing. Verified output enables energy credits. Once data becomes part of that output, electricity stops being a simple commodity and it becomes a data-backed service. Across the global economy, data has become a form of capital. AI runs on it, markets price it, institutions depend on it. So when electricity generates data, verified time-stamped, location-specific data, it adds a second layer of value to every watt produced. Not just energy value, information value. A megawatt hour is no longer just a unit of power. It's a unit of measurable activity inside the economy. Watts now generate information, and information is what the financial system runs on. Now, let's talk about combined cycle gas turbines, CCGTs. These plants combine a gas turbine with a steam turbine that captures waste heat to generate additional power. Efficiency can exceed 60%, with the newest plants reaching even higher levels, around 62 to 65. Don't quote me. They ramp quickly, they run reliably, they stabilize grids dominated by intermittent renewables. In a tokenized energy economy, reliability is value. CCGTs don't just sell electricity, they generate stacked revenue streams. Energy market revenues, capacity payments, ancillary services, reliability premiums, emissions displacement value. A megawatt delivered during peak demand from a dispatch plant is not economically equivalent to a megawatt delivered during surplus conditions from solar. Markets are pricing that difference more precisely every year. Traditionally, these cash flows are financed through bonds, infrastructure funds, and utility balance sheets. Tokenization doesn't replace the system. It modernizes how claims on those cash flows can be issued, tracked, and settled. This is not retail investors buying power plants. It's evolution of infrastructure finance. Renewables accelerate the shift. Solar and wind don't just produce energy, they produce proof. Zero carbon generation, time-stamped output, geographic origin, environmental compliance. These attributes underpin renewable energy credits, carbon offsets, clean energy certificates, grid balancing incentives. Historically, these were tracked in fragmented registries. As verification becomes real-time and auditable, these attributes can be digitized and structured more precisely. Tokenization here is accounting modernization, turning verified energy attributes into programmable financial representation. Energy markets are evolving. They're evolving from just asking, how much electricity did you sell, to asking, what kind of electricity did you provide? And when did you provide it? When did the grid need it? This creates layered value. Reliability credits, capacity credits, emissions credits, flexibility incentives. Infrastructure assets now generate stacked revenue models. Stacked revenue increases complexity. Complexity increases the need for better settlement systems. Tokenization is less about disruption and more about precision. And as pilot projects from utilities, energy companies, and microgrids have already shown, those digital credits can be anchored directly to real power generation and environmental data. It aligns energy measurement, financial structuring, settlement infrastructure, compliance frameworks. The result is a system where infrastructure cash flows become more transparent and administratively efficient. Electricity is becoming a base layer asset, a risk management input, a hedge against digital demand, a monetized system of trust. AI data centers and digital networks don't run on narratives. They run on uptime. And uptime depends on reliable power and reliable financing. Tokenized energy credits won't replace power markets. They will make them more precise. Tokenizing power isn't about turning turbines into coins. It's about recognizing that power has attributes. Attributes have value. Data verifies those attributes, and value requires modern settlement infrastructure. The future economy won't be built on whoever writes the fastest code. It will be built by whoever secures the most reliable power and finances it intelligently. Until next time, learn, adapt, and prosper. Stay energized, everyone.